Hi, I'm Jared Dillian. I'm here with George Goncalves of MUFG. We're going to be talking about the bond market. We're going to be talking about rates. Let's jump right in. The last couple of weeks, it's kind of been in arms race as to see who can be more hawkish. And, I've been tracking this pretty closely over the last couple of months. I've been watching the Fed funds curve. We went from a couple of hikes to 3 hikes to 4 hikes. Now we have 5, 6, and 7 hikes being predicted by different strategists. At what point do you think we're getting out a little bit over our skis here? At what point are we sort of over? And I get it. I get it that the Fed is having some political pressure to do something about inflation. But I think it kind of seems as though we're pricing in a little bit too much tightening at this point in time.
Look, I think that's a great point. And by the way, great to be back on RV and nice to kind of meet you interactively, Jared. I've been following your work for years. It's great to be with you. So listen, I think, markets have this tendency to kind of overshoot and over extrapolate. I think we're in that sort of moment, but to judge when that's over, it's going to be really difficult because and on the one hand, I think the data is going to give the Fed the ability to eventually pause in the second half, but what if that doesn't happen? And so you kind of have to assume that they're going to either go all the way and then wait to see what the impact is to financial conditions and the economy. But I do think that there's kind of this view out there that, we're back to a normal business cycle. Once COVID passes, we're going to go back to a normal business cycle. In my view, I think, if you exclude, obviously the COVID impact was a massive hit, but we really elongated the old business cycle, which was going on 10 plus years anyway. So we're now dealing with an even more leveraged system than before, and the Fed wants to take away liquidity. Fine, they should, because there's excess liquidity. They helped facilitate some of the fiscal stimulus, which exacerbated this inflation. So they're really in a difficult spot. I'm of the view look, they want to soft land the economy, so they want to achieve Goldilocks. Everyone loves Goldilocks environment, not too hot, not too cold. I think that, they could get it right. It's possible. That's definitely one plausible scenario. But for me, I think there's a risk of the policy error eventually kind of amplifying the mid-cycle slowdown, which I think is ahead of us. And this business cycle is going to be shorter because it's really part of the old business cycle. And so if that's the case, there's a risk that they do a policy mistake and they actually, tip us into a more sharper slowdown and potentially maybe a recession in 23. So we'll see.
Well, they have potential to do 2 policy mistakes. They kind of have to thread the needle here because if they do too much about inflation, then they risk a recession. If they don't do enough about inflation, then that's also bad. So they have to kind of find the right balance. And about the business cycle, one of my theories is that we don't have, at least as of about 13 or 14 years ago, we don't have a normal business cycle anymore. What we have is a perpetual boom that just goes on forever, that is punctuated by the occasional crisis, right? That's replaced the business cycle. So, so in that environment, what is the Fed going to do?
And look, that's the thing, though. The problem is, though, if you listen to folks across the street, they're still thinking there is kind of a standard business cycle. And I think your point is a good one, but it's about how people operate. So if everyone thinks there's a business cycle and that the Fed could create these boom bust periods that are either punctuated by crisis or whatever the case may be, people are still acting as if this is a start of a virtuous growth cycle. In fact, I think they're just elongating the old cycle. So what could they do is hit it hard initially. So front load a lot of their tightening and then see what happens. I think this past January, it was a rude awakening. Obviously we had a lot of volatility in the markets. A lot of it was kicked off in the rates market, but at the same time though, there was no place to hide, there was no place to run to, no place to hide. Equities were down, fixed income was down. Just floating rate product and commodities, right? Those are the only 2 things that performed well in January. I think that was a stark reminder that if we get a bigger financial conditions tightening, the Fed can't do much, because just like they can't solve the bottlenecks in the supply chain, if we get a slippery slope on risk markets, they can't stop it from falling.
Yeah. The other thing is that I think if you let's say you had advanced knowledge of what the Fed was going to do for an entire year. Let's say you knew they were going to do 50 in March, then they would do 25, then they would do 25, then they would pause for a couple of months, then they would do 25. Even if you knew that entire path of Fed tightening, you still couldn't make money off of it. Like, there's nothing you can do with that information because you don't know how the market is going to react to it. The other thing is that, and this is my point about the Fed, like, the Fed has 250 PhDs. Everybody, we all knew colloquially, we knew in 2020 that fiscal stimulus and monetary stimulus was going to cause inflation coming out of the pandemic. Everybody knew inflation was going to happen. And the Fed, I don't know if they didn't predict it or they saw it coming and didn't do anything. But the point is that they didn't do anything about it until inflation became a political concern, right? So once it turned into this scenario where lawmakers are not going to get reelected because of inflation, because inflation is the number one concern for voters going into the midterms, then it became a problem. Then the Fed did something about it, but they've been the opposite of proactive. They've been reactive the entire way.
Because inflation, as you know, is a binding constraint for them. And, of course, politics are influencing everything. However, I mean, they've been lucky for the last 20, 30 years. They've never had to start a tightening cycle with inflation sitting on their backs. So I do think that changes the whole narrative for sure. But as we kind of get further down the line, it comes down to, can they actually, put it this way, like they are reactive at this point because they missed that window of actually acknowledging inflation much sooner and also addressing it. Now the question is, like, they've acknowledged it, but if you look at the way the markets are responding, the Fed's still easing, by the way, which we all know, right? They haven't even finished tapering. And so they haven't even started the tightening cycle, but the markets are acting as if the tightening cycle has begun. So to your point about, like, even if you knew all the information about what the Fed was going to do next, it's almost like I draw the analogy like Back to the Future too, like when Biff went back in time and looked at and gave him the sports almanac and he was able to bet on every single game. That's much more binary, so it's much easier to forecast. So I completely agree with you. Even if you have all the information, you're not going to be able to, like, judge how the market's going to react to that. And so, I mean, I think but the Fed has an element of that too. They know if they over tighten, they run the risk of a real severe tightening of financial conditions, and that's going to quickly feedback loop into the U.S. economy. We are so levered to the wealth effect. So they know that, but how do you modulate, right? The only way you can do it is actually put it in place and see what happens.
So where do you think financial conditions are right now?
I would still say they're loose. They're still loose, very loose.
Even with the yield curve at 60 basis points or whatever, you still think they're pretty loose.
There's two conflicting forces going on here. One is that we're starting off with a very flat curve, but very negative real rates too. So, like, real rates have had a big move up, but they're still, like, in the financial repression zone, as I like to call it. I have a chart of that which shows, real rates have been a good kind of precursor for, like, market volatility. And if you go back, even 20 plus years, every time you have a 80 to 100 bip move in real rates, that rate of change will cause something to crack or a repricing or de-risking, right? So you have the real rate angle, but it's still very negative. So that's, like, still accommodated, in my opinion. And it's forcing people to that whenever you do see a dip, they're like, oh, I got to go buy a dip because I'm being penalized because inflation's high and I have nowhere else to put my money. So the real rate part is interesting. And then you have the curve flatness, which is the long-term structural bond market participants saying, you're going to make a mistake. We know you're going to make a mistake. There's no way out of this. And you're going to have to then, forget about the actual policy now. They're thinking 2 or 3 steps ahead saying, you're going to over tighten potentially, fine. And then we're going to see a recession or a really shallow recovery path. And you're going to have to ease. So like those big conflicting forces, I mean, I think the long-term bond players will end up being right, but if they're wrong, like, this will be the first time in 40 years, as you and I know. And, like, if the bond market is wrong on the terminal rate and how high rates can really go, there's a lot of problems out there that are going to get kicked off, as you know.
So one thing that people like to talk about is the Fed put. this implicit Fed put that we've had. And you go back to like 2015 and the market would go down 8% and Bullard would go on CNBC and, just make some, reassuring noises and stocks would rip 10%, put in new highs. I mean, we did this for like 10 years, and people, the Fed, in its directives, in its speeches, in all of its communications, never said that they were explicitly supporting equity prices, but in all their actions, it really seemed like they were supporting equity prices. And now it's totally changed. And I think that the Fed was the last to see a bubble in stocks. I think they were the last ones to figure it out. But now that they figured it out, I think that, the market's down 10% ish. And I think that they view this asset price decline as welcome. I think they actually like it. That's what they want to see. So the Fed put isn't down 10%. It's probably not down 20%. Maybe it's down 30%. What are your thoughts on this?
That's true. I mean, the one thing we probably both agree, it's not zero, right? So or it's not like there's a put out there somewhere, right? We just, and I hate trying to guess at it. I mean, I think for me, it's more about the direction of travel plus what happens after the initial shock. If we, right now we're trying to bounce back, right? So we had the move in January, we had 2 days on the up move and on the equity indices. High yield is kind of trying to figure its way out here, but if we stabilize and make another run to a new high, then did it really matter? It's more about if this is more of a rethink about liquidity and the role that liquidity plays in the system. If we get a 20%, 30% correction and it stays down and it doesn't bounce back for 3 or 6 months, I think that's when they care. So I think it's a combination of the magnitude and if it is sustainable. So that's how I would frame it, that this noise of markets up and down 10%, I'm with you. They probably are pleased to see that there's froth being taken out of both, high beta stocks and also crypto. I mean, they probably look at this and say, hey, this is good. There was too much liquidity, obviously, by the way, of their design too, right? So
one thing you mentioned in passing, which I agree with, is you didn't say it exactly this way, but you were talking about sort of the velocity of real rates and how fast real rates come up. It's not really the magnitude of the move in real rates, it's how fast it happens. And we haven't really seen anything like this since February of 1994. I mean, that was the last time that you had a big move in real rates that happened really fast, and it created all kinds of problems. You see something similar happening this time?
If it were to continue, sure. I mean, so the challenge is, and it has been, I know we're going to be talking about this throughout the conversation, is the portfolio balancing channel did push money into credit and high yield and into alternative assets and eventually up to equities and everything else. But the purely looking at the fixed income domain, there was a substitute effect. If the Fed's buying all the treasuries and all the mortgages, we're just, we're going to buy the other fixed income parts of the complex. And now if that's going in reverse and real rates are the ultimate kind of arbiter of duration risk. So if there's a big duration shock, which we had a little one in January, I mean, I don't think that's the big one. I mean, I keep telling investors that this is not the big one. I think that if there's another 100 bips behind that and real rates really go close to positive, which is every time they've done that, something bad has happened. In 2015, you had China devaluation, you had the oil market. I mean, the frackers couldn't handle it in 2016, right? The only saving grace and difference from then, of course, oil is now high, but that's not also a permanent, sort of situation. I mean, oil can come back down too, but purely just real rate shocks over the last 5 years, last 10, 20 years, every time we happen, it sniffs out where the risks are in the fixed income space. So it's going to find that risk in the fixed income space, and it's going to make itself known. And then I think that the focal point will be credit. It's not that we're going to have an '08 crisis, but it's just more that you're going to see real losses take place in your fixed income portfolio 2 years in a row. I mean, I think at some point it starts to matter, and then you're going to see a flight to quality back into treasuries when rates are higher, when mortgages are cheaper. And this rotation back to liquidity products, which the Fed should not have bought as many, in my view, like they took it out of the system. Like they need to have that handoff. And like that handoff, if they do it over 2 years, 3 years, fine. But you and I know that nothing lasts for 2 or 3 years. Like it looks great on paper. You see all these projections of like, hey, the Fed's balance sheet's going to shrink $3 or $4 trillion. I'm like, really? Okay, let's see that happen. Like, I mean, I want to see it happen. Like, it's not going to happen. Not in my view, at least.
We'll get to credit in a second. I do want to spend some time talking about credit, but in terms of terminal Fed funds, I mean, when I think of terminal Fed funds, I think they could stop around 1.5. Does that sound reasonable to you?
Yeah, that sounds reasonable. I mean, so we're not too different there. I'll give you my theory on how I come up with the number. I'm curious what you think too. So if like this financial repression thing is a mandate and they have not really underwritten it because it's not like their official mandate from Congress. So we've had negative real rates for such a long time, both in the actual market, but also with the Fed having Fed funds under inflation for long periods of time. If you go back and look at even like the 04 to 06 period, which ended up with the subprime crisis and a misallocation of capital, right? Even during that period, up until like 2/3 of the hiking cycle, the real Fed funds rate, so if you subtract inflation, was negative. So they've been for like last 20 years, basically on average, having a negative real rate policy without letting us know. So they're like, okay, -1% is the target, is in my view. Let's say it's like negative, it's whatever, anything under 0. Then from 09 to 17, when they kept rates on hold forever too, and they started to hike in 15 and 16, they only crossed over into real rate territory in like the latter half of 2018. We all know what happened to the high yield market, into the IG market back then as well. So like once real cost of capital gets expensive in the US, it starts to kind of, gunk up the system and it slows it down. And so I think they have a real rate target, a negative real rate target. They haven't told us. If it's 1.5% nominal Fed funds, and let's say they manage to get inflation down to 2.5% over the next couple of years, that's -1% real Fed funds, right? So like I agree with your 1.5. I think like they're going to hit it hard and try to get rates up and then see if like markets have an issue with that. If they do, they can go on hold, get through the midterms, look at next year. And if we get another couple hikes up to 150, that's probably as good as it gets in my view.
Do you see any scenario in which we get back to like positive 2% real rates? I mean, that's what we had in 2000. We had Fed funds at 6.5 and inflation at 4.5, something like that. Like, is there any scenario in which that happens?
In 20 years, maybe? I don't know. We have to, I mean, like, Jared, think about like, you know the charts as well as I do. Like our debt to GDP profile looks like we've had a World War II, right? Like we basically had a world war in the last 20 years in various forms or another, right? So that buildup of debt on the government side is one thing. And if you look at the average interest cost for the US government, and convert it back into yield terms, so like how much debt is outstanding, like what's the average coupon for all the fixed income securities that the US government has issued, it's averaged about 2% since 2012, 2011, 2012. So from 2012 to now, basically our cost of funds as a nation is 2% running. So we cannot really get to that 2% nominal. So you need to have negative real rates to force it. Because if you got to a 2% real, and that's like a 4% all-in yield, I mean, literally we can't afford it. We just cannot afford it. We'd have to start to then pick and choose around like, entitlement programs and spending on everything else in the government. Like it just won't work. That's where, I've worked at, Japanese banks for over a decade. That's where, like, when I speak to, investors in Asia, they're like, you're going to have a similar situation that you better hope that you can maintain GDP high enough so that you're just kind of whittling away your debt load. Like that's the only way out of this. I just can't see how we can have a super positive rate like that. And if we do, it's going to break something in the bond market, which is linked back to pensions, back to insurance companies. It becomes a big downward spiral if we get meaningfully above 3%.
Well, you mentioned, you said if the Fed is successful in getting inflation down to 2.5%. I don't know if that was like a Freudian slip or something, because I don't think they're going to get inflation down to 2.5%. I think they're lucky if they get it down to 4 or 4.5. I think inflationary psychology has taken hold, and it's going to be really difficult to reverse. So, yeah, I don't see inflation getting down to 2.5.
That's where, well, it depends on timing. I mean, like their outlook towards 23, 24, so 2 years out, you can get down there if you believe in their outlook. This year, I'm with you that it's going to be hard to. I'm somewhere around 3.5 to 4, just because I do think in the second half there's going to be an inventory glut of epic proportions. I do think that once we get COVID really behind us, you're going to see labor force participation rate increase. You're going to see the unemployment rate also go up as people come back into the jobs market instead of being at home for various reasons. So I do think that in the second half there's going to be a labor glut, an inventory glut, and there's going to be disinflationary forces in the second half, which will take down inflation into the high to mid threes. Now, if that's my view, I could be wrong, obviously, right? I mean, and there is inflation expectations are now becoming, on a running basis, pretty elevated, and that starts to impact the psychology. To your point, I do think that if time passes and people look up and they say, oh, all these durable goods that I was buying for the last 2 years while I was at home, I'm not buying them any longer. Now they're cheaper. I think that some disinflationary pressures will come in the end of 22 and early 23. And then, if they get down to 2.5, again, that's an assumption. I'm not saying it's going to happen, but I do believe they have a chance at doing it if financial conditions tighten, because for me, it's all about the wealth effect. And if we take away the wealth effect, or if you stop seeing higher highs all the time, I think that is disinflationary back into the economy. So we'll see.
That's a pretty good prediction about the labor market and inventories. I think that's pretty interesting. So one of the things I was thinking about was, I started my career in 99, and my knowledge kind of goes back to 91. So I remember the recession in 91 and 94, 97. But, as I think through all these corrections or bear markets over the last 30 years, none of them have really been caused by the Fed. Right. And even in 94, when the Fed started ripping rates, it didn't really cause a bear market in stocks. So I just, I was actually writing about this in one of my recent newsletters. I'm look, I kind of don't see a scenario in which we get this big multi-year bear market as a result of Fed tightening, because that just doesn't usually happen. I think that we sort of collectively think that the Fed has a bigger impact on equity markets than it actually does. But in reality, the equity markets absorb rate hikes better than we think they will. You know what I'm saying?
Sure. No, so I'm not, again, 1%, even 150 is really nothing to write home about. That's not it should not be disruptive but it's the speed and the timing of when it's all relative to where we are in the cycle, and it's all relative to the starting points. And you and I both know all the valuation metrics are very stretched for a number of asset classes. And even with this minor correction, they're still stretched relative to history. So it's the starting point of when they're doing this adjustment, plus the real unknown. And even Chair Powell in the most recent press conference, it's we still don't understand the full impacts of the balance sheet. I was you've been doing QE for the last 12 years, and you obviously use it when you need to use it. So you've doubled and tripled the balance sheet. So you know that when you're increasing it, there's some sort of symmetry towards risk taking and more liquidity. So you're telling me on the unwind, there's you don't know how it's going to work. I mean, that was because they got so much in trouble for saying it's watching paint dry, and it was not watching paint dry. We just don't know the linkages of all these different liquidity channels in the system. And as they for me, the biggest thing is QT, the quantitative tightening, and the balance sheet unwind. The rate hikes up to 150, I'm not as terribly concerned, just depending on how fast they do it. It's the double tightening of draining the liquidity as well as the actual hikes. That's different than anything you and I both experienced since the early 90s. We didn't have this different policy.
You want to talk a little bit about the micro aspects of draining that liquidity and RRPs and stuff like that?
Yeah, sure. I mean, there's a chart that I have, and hopefully you guys can put it up. It's the Fed balance sheet, and then I net out the RRP. And first and foremost, I mean, you'll see this massive spike around the COVID response. But then after that point forward, it was a steady kind of QE balance sheet expansion, which we've seen, post-financial crisis. But then sometime in the middle of last year, as they introduced this reverse repo program, it's, there was, I call it like a sterilized QE. There was just too much reserves saturating the banking system and the financial system at large that it needed an out. It needed like a relief valve. And the RRP, the reverse repo program, ended up playing like a relief valve. So like over 1.5 trillion, close to I think 1.7 the peak. This is some large number of liquidity that left the banking system and parked their cash in money funds, which then there was not enough short-term paper. Then it went back to the Fed's balance sheet. Like that 1.7 trillion is one of the reasons why they can drain at least $1 to $1.5 trillion out. 3 trillion, I don't buy it, but at least 1 trillion they can get out, because that inert money is just sitting there because they did too much QE in 2021. Like basically that's all it came down to. But you and I both know that markets operate through the expectation channel and through the announcement effect, and just also this is an unknown. So you're telling me that, hey, the idea that the Fed is injecting all this liquidity, I have to chase yield and chase return. On the flip side, when they're draining that liquidity, that announcement effect on sentiment could be like, oh, the Fed really does not have our back. They're actually coming out and taking away liquidity from the system, even if mechanically that's not how it actually all works out. That sentiment effect combined with the hikes, that's why I feel like this is such a different environment than what we're used to.
Yeah, let's talk about the yield curve. 2s, 10s, 5s, 30s. I actually haven't looked at the forward curve in a while. I used to look at the forward curve more in my Lehman days. But what is it telling you here?
Well, everything's super flat. I mean, and the further you go, we flirt in and out of inversion. So the forward curves are nervous about, hey, again, this is why the long-term rates are not moving either, that the Fed's going to hike too much. But if you look at the normal curve, and I started looking at some stuff because I'm a big believer of this speed concept, and that speed can get you. So right now the 2-cents curve is somewhere around 60-ish, 60, 70, right? Like we only get that flat on like the 2-10s curve, again, when the Fed is nearly 2/3 of a hiking cycle or halfway through a hiking cycle. They haven't even hiked yet, as you and I both know. Like they haven't even started. And the curve is already as flat as if they had hiked already. So this is like the idea that the markets are jumping ahead, way ahead, saying like, all right, you're going to hike, but good luck with that.
That's not unjustified though. I mean, they've been jawboning this for months. You know what I mean? So, I mean, here's another question.
Yeah.
If they succeeded in flattening the yield curve this much just by jawboning, are we actually tightening without actually de facto tightening? Like, is this a tightening?
I wouldn't go that far, like I mentioned before, because we haven't had the real rate move, but also enough to actually tighten. But the mechanical aspect of raising rates does take away liquidity too from the banking system. So like, I think you need to actually physically hike, not just give guidance and try to push it up through jawboning, as you say. Look, I think, I think the analogy that I keep coming back to, not because I'm obsessed with the .com or the late 90s or 2000, but that was a very shallow hiking cycle too. I'm sure you remember we were starting from higher rates, no less, but it was a shallow hiking cycle. And what really, you could say valuations were probably more extreme across the NASDAQ. But if you look at what really did it in was that 50 bip hike in March of 2020. 2000. That March 2000 hike of 50 bips, that inverted the curve. And so the curve's being so flat, there's very little room for error here, like margin for error here for the Fed to get this really right. And I think the other point that I'm starting to observe, when you get a convergence of the 2s 5s curve, so the shorter end of the curve, the 2s 10s curve, and the 5s 30s curve, when they all start having the same spread relative to each other, that's closer to the end of the cycle than the beginning. So maybe they can hike 3 or 4 times, which is kind of my base case for this year. And then that's really it, because otherwise I don't think they're going to flip the curve and invert it. And if they do, then you really have the risk of that, kind of more of a tighter financial conditions, which that will really sink in. And then that's when you get that negative feedback loop back into the economy, which then will cause them to pause. So look, they could do it because we don't, like, nobody knows, like you and I don't know like what the threshold is for this pain level, right? Like, but we're much closer compared to all historical, comparisons.
One of the things, I mean, we had a call before this, and one of the things you said was, everybody kind of extrapolates everything to the extreme. And, we think that because they're in a hiking cycle, they will hike till the terminal rate and they're going to go all the way and they're going to be done. But there's a lot of path dependency here that we don't understand. Like you said, like they have a pain threshold and, they could pause and a lot of things could happen. I mean, I guess the point that I'm trying to make is that, I think investors make plans. They say, okay, the Fed's going to do 25, 25, 25, 25, 6 times, and they'll be done. But there's a lot of exogenous things that can happen that we just really have no idea.
That's true. And that's the whole risk to this whole thing, because we're now at the beginning of the year. We had that rude awakening of like a pretty big downdraft in declines in stocks and bonds as well, right? Because, there was, again, the big losses across the board. And now everyone's in this defensive mode, and now they're extrapolating and they're trying to kind of come up with the idea. Well, I mean, now I can reconcile my positions if I know that 6 hikes in the past used to do this, or like there's a lot of this kind of goal-seeking behavior going on. I'm like, oh, I can back into this. I'll know what I'm going to be able to perform this year. It's like, no way. I mean, 100%. It's totally path dependent. You're right, and that's why I feel like you got to be. Like, just like the Fed wants optionality, we need optionality too. Like they're trying to brainstorm and have all these tools that they can use, and but they haven't even told us exactly. They haven't even hiked, right? So once they get onto a plan, I think that should also will take away some of the volatility in the markets and all this second guessing. But I also feel like depending on they're never going to tell us we're going to hike to 1.5%. I mean, they're never going to ever give us an end point for anything, the balance sheet or rates. But we're just naturally wired, I guess, as humans to kind of always look linearly and kind of project forward on where things are going to go. And I can't believe it. Like, seriously, like this is going to be the second or third time in my career that we're guilty of this extrapolation phenomenon. Like, we did it in 2009. We're like, oh, now the Fed's going to hike, and people were going to hike to 3 or 4%. Never did it for 10 years, right? Or 8 years. Like we're doing, and then we had, of course, COVID, and before COVID, people were like, oh, the Fed can stay on hold forever. I'm like, they're never going to stay on hold forever. Like they cut rates in 2019, then they had to deal with the repo crisis. There's always something that comes up, to your point. Like there's always something that comes out of left field. This idea that you can just have a stationary and that I can extrapolate the future. Why it still happens, I don't know.
So let's get into credit. So we never really had a credit cycle during the pandemic. Spreads gapped out about 300 or 400 basis points, 500 basis points. The Fed stepped in. They started buying individual corporate bonds. They started buying the corporate bond ETFs. And basically the credit cycle lasted like a week, and that was it.
Exactly.
So, which really deprived a lot of people of yield, to be able to buy some credits at really attractive levels. I remember 2002, the credit markets were a mess, and you could get, high yield paper at like 12, 14%, and we did not have that opportunity in this last time around. So now it kind of seems like the credit markets are trading. You want to talk about Fed puts with like an implicit Fed put. The stock market's been a little bit of a mess for the last couple of weeks, and credit has barely moved. That's one of the things I look for as an indication of stress in the market. You look at the VIX and you look at credit, and VIX has been high 20s, low 30s, nowhere near panic levels. And credit has widened a little bit, but like nowhere near panic levels. So what do you think?
Look, I think you're right. I mean, I'm sure there was a lot of distressed funds that were like looking at 2020, early 2020, saying, "Hey, there's going to be value finally," and then it completely got mopped up with all the Fed actions. But that psychology has persisted, in my view, all the way throughout, because now the idea that, and maybe we should rethink, what is the Fed put? It's all about credit more so than anything else. So if like there's this belief, because the Fed this time actually did buy credit, like this time it's not all about them buying treasuries and mortgages and forcing people into credit. They took it one step further. Now, I don't believe the ability for them to do that again exists unless we have another crisis. And so it's almost like the credit, complex is, kind of low vol and, has this false sense of security that the Fed will bail them out. I don't think they will. I mean, I think it would have to get really squirrely for the Fed to come back into the credit markets. I think now credit markets are on their own. The facilities won't get turned on as easily unless we have something come out of like left field. And so I feel like you have to start doing your credit homework this year and the next year. Like I think because the fundamentals of the economy, we had this big, knee-jerk jolt higher because of the reopening and a lot of stimulus. Now we're going to get back to either trend growth and maybe wrestle with all these drags between the Fed tightening and fiscal drag. But nonetheless, like you're gonna have to pick, just like you pick stocks, you're gonna have to pick credit much better like going forward and look at the sectors that make sense into this, like both the new economy, but also an economy that came off of, a lot of like liquidity. So like bottom line for me is like, I think credit is still not giving us the signals, which is why I don't think this is the big one. I think what we saw in January was just a glimpse. As heavily duration sensitive credit has become, as rates rise, it's going to start to really tighten the screws on the credit markets, and that's going to lead to relief, like sell-offs and like spread widening.
Well, that happened in 2013, if you remember that.
Oh, totally.
Yeah.
No, so I think you and I are both market laissez-faire type folks, from what I can tell, and like we want market forces to dictate price discovery, right? So if that's the case, what we saw in January was not real price discovery. That was de-risking and like moving around some of the pieces on the board. If we get proper price discovery, I think credit is where you're going to see it. It hasn't happened yet in 2022. I think it will. That will then feed back into equities.
I mean, one of the things I like to do as a trader is I like to look around at like lazy longs, like people are just kind of like hiding out. And I mean, credit to me seems like a lazy long, like people are just collecting 4% coupons and, like you said, the false sense of security, like, if something happens, the Fed can bail out credit again. Like it seems to be, like I said, it seems to be a lazy long,
Yes, or complacency, whatever you want to call it, right?
Yeah.
I mean, there's so much cash still in the system, right? And so like that's the other problem, right? So that's why none of this stuff really matters until the Fed really pulls the trigger on QT. Let's see. I mean, like that's why I'm not an extrapolator. I try to think about all the different paths, and if they do the hikes and the QT at the same time, credit is going to get it. They're going to feel it. And that's going to, finally expose, the strong hands versus the weak hands. And I think that, plus, which corporates can actually handle the higher rates. I mean, going into COVID, there was this big obsession around the triple Bs and zombie companies. Like, what happened to those places? Like, I mean, they're still out there. Just that, when rates are low, you can kind of service your debt. So, I mean, like that's not resolved.
Yeah. When I think back to 2013, that was Apple's first bond issuance. If you remember, like they issued their first bond and they issued it at par, and a month later it was trading at 90, and it was all duration.
Yes.
And people were like, I didn't know interest rates could affect the corporate bond. Like, they had just totally forgotten, it was like they just forgot about duration.
Yeah, I think there's definitely an element of that going on now, and I'm not sure there's enough hedging going on for rates to suggest that they're going to weather it better this time versus 13. Having said that, there is, some signs of de-risking. So let's see. I mean, I think it's going to be like a traditional stock pickers market, but there's going to be a credit pickers market. And the sectors that make sense are the stuff that, the stuff that did too well during the pandemic period, like cyclicals and just kind of like, basically, it's like a minor version of the equity market, as you know. So like you have to pick and choose the sectors you're going to be in, but as a complex across credit, I don't think people are perfectly hedged for a bigger rise in rates for sure.
So let's talk about some international stuff. So the dollar has strengthened quite a bit over the last couple of months, but it's all because of interest rate differentials, and mostly US and Europe. We went from pricing in 0 rate hikes to 5 rate hikes, and the ECB is at 0. And that explains 100% of the move in the dollar for sure. The BOC passed on a rate hike. The US was behind in terms of tightening for a long time. But now it seems like it's moving ahead. What do you think?
Well, I mean, I think that at some point there's going to be a synchronized tightening as well. It might be delayed, but it's going to be hard for all of G10 the Fed only being the only one that tightens, or the BOE or the BOC. I think eventually Europe has to do it as well. But they suffer from the same problem, which is, forget about real rates being negative, nominal rates are negative, right? So can they get back to a positive nominal rate environment without really exposing the fragilities of the Eurozone? You look at the German Bund, it's finally back to 0, and people are applauding it. Like, yeah, we're back to, in 10 years time, we're going to get back our money and not just pay into it. So I think Europe is going to be even further behind us, but they cannot completely ignore what's going to happen to their currency if the dollar continues to strengthen. So I think there's going to be a point where there's going to be some synchronization around central bank policy action. And that also, by the way, takes some of the pressure off the Fed, because if you recall, from 15 to 16, there was some hiking. Then from 17 to 18, Fed was the only real major central bank that was tightening. So if this time, because again, the nature of the pandemic was different, everyone over-eased, they've realized it, now they're having inflation problems in their local jurisdictions, all of them have to pull back a little bit, at least show the effort that they're doing that. Otherwise, either you're going to have either political pressures, or the populace is going to get upset with all this inflation. So the central banks have to do something, right? Like this whole concept of doing something, they will. So I think a global central bank tightening will take pressure off the Fed, and then the dollar will then stabilize eventually. But again, these are all different scenarios that I'm giving you, which are predicated on them actually taking notice and doing hopefully the right thing. So I think the Fed will at least be the first mover and get us out the gates to higher rates. And Europe will be delayed. They'll be forced into it. The question is, they always miss their window. They missed their window last time, and then the Fed was in a hiking cycle. They did nothing. And then you look at Japan. They're basically, they can't raise rates for basically ever. So I think we're in this really, we're in this window of time where, because of the pandemic response and a lot of easing, you're going to see tightening across the G10 for the first time.
Cool. George, it was great talking to you. It was great to talk to you in person.
Yeah, likewise. Yeah. Good to connect finally. And thanks for the interview.
Yeah. Thanks for joining me and George on Real Vision, and we'll see you next time.
Appreciate it.
Hey there, revolutionaries. To join a community sharing insights like you just watched, head over to realvision.com. There you will get unbiased insights and exclusive access to the very best, brightest, and biggest names in finance. Be a part of our community of lifelong learners. See you there.